Welcome to The Driven Deal, the podcast where real estate professionals, investors, and industry experts share insights, strategies, and trends shaping the market. I'm your host, Jose Angel, and in each episode, we dive into game-changing tactics, automation, and success stories to help you stay ahead in the real estate world. Whether you're an agent, broker, or investor, this podcast is designed to bring you valuable knowledge to scale your business. Let's get started. On today's episode of The Driven Deal, we're excited to welcome David Moret, president of Highline Real Estate Capital. With over 2 decades of experience in real estate investment and asset management, David has built a reputation for identifying and executing high-value opportunities in commercial real estate. At Highline Real Estate Capital, he focuses on acquiring and repositioning properties to create long-term value for investors and stakeholders. David's expertise spans capital markets, investment strategy, and market trends, making him the perfect guest to discuss how to navigate today's real estate landscape, find strong investment opportunities, and build a resilient portfolio. Get ready for an insightful conversation with a seasoned real estate investor and industry leader. So, what does a typical day look like for you, running your company and everything?
They're all different, but I've got partners here and a team, and at any given day we're spending some time looking at new opportunities. We might be spending some time arranging capital, whether that's fundraising for our fund or developing relationships, expanding relationships with the larger partners that we use our fund to co-invest with. And sometimes it's arranging debt for an acquisition we're doing. But at any given time, we're looking at a pipeline of new opportunities. We might be, as we said, today's example, we are in the final stages with two partners of closing a $220 million acquisition that's going to close in a couple of weeks. We expect to be awarded a new acquisition today, and then we're dealing with various matters with all the different properties that we own. And we're also working on fundraising because we have the final closing for our fund vehicle that will occur in the first week of March.
Nice. So every day seems different, and every day there's a whole new set of activities to go around, right?
Absolutely, yes.
How large is your team in Highline Real Estate Capital?
Yeah, so our primary team in our corporate office, there's 4 of us. In my prior life at Crack, we did everything on our own. We had in-house accounting, in-house management, in-house construction, in-house leasing. This version is not wanting to have such a large team. We really outsource a lot of what we do. Have either partnerships or arrangements with third-party service providers to do our management leasing. We have accounting that we outsource for both our fund and our property level and entities. We have different partnerships that we buy different asset classes with who have those vertically integrated structures. And we also have 2 different individuals who provide, analytical support for us. So they're not full-time, but they work with us part. So I guess you'd say totally 6 plus outside outsourced departments for the different functions.
Nice. Any major shifts that you're seeing in the industry right now, David?
So, when I think about that question, obviously you could be asking a question as it relates to things like technology and changes, and there's certainly some of that. But I'm thinking more in terms of just the market, the cycle of the market, if you will. And so, after COVID, we had a tremendous amount of fiscal stimulus injected in the economy. Right? Everyone got free money, PPP money and grants and all these other things. And interest rates were, quantitative easing and whatnot. And interest rates were pegged close to zero for several years. And so that resulted in an incredible amount of capital flowing into the space, and buyers, and lenders striving for yield and pushing yields down, prices up. And so, once the Fed started raising rates after inflation ticked up, we anticipated correctly that there would be dislocation market. And so what we're mostly seeing now is, after a couple of years of extended pretend where borrowers would go to their lender and say, I can't pay off this loan. I borrowed from you at when rates were 3%, now they're 7 or 8 or 9, depending on the asset class. I can't refinance out. They were given more time. And so we had a very slow transactional environment. 22, second half of 22, all of 23, and even the first part of 24. But we're definitely seeing a shift now where lenders are starting to get more comfortable. Maybe their position is not as impaired. They've given their borrowers a few different extensions, and now it's time for something to happen. And so we're just seeing a large flow of, we'll call them distressed, but we're not really seeing much distress like it was after the financial crisis. People were, completely underwater, but we're seeing distress where borrowers are underwater, impaired. Maybe the debt's a little bit impaired, and you're just seeing forced transactions. That's where more business comes from. The other part of it is in the office sector, where, I think people painted office with a broad brush. And for the last couple of years, all office was bad. And what we're starting to realize around the country is that, there's a flight to quality, and it's still demand quality office. They bring in their employees back to the office, and to do so, they better have a good offering. And so the top part of the market is performing incredibly well, and the bottom part's not. So, but that being said, there's still a desire by many institutions and funds and lenders and others to reduce their office exposure. And what we're seeing in some cases is, if you go out and try to sell your bad office, you're going to get destroyed. You're going to get pennies on the dollar, and you're going to take a giant loss. So we're seeing some institutions go out, well, what's liquid? What can we sell kind of near the value we have it marked at? And so they're selling higher quality office. And so we think there's been some interesting opportunities to buy quality office that in any other time would have priced as core institutional asset, if you will, that's now priced as value add to opportunistic, just because capital doesn't really like office yet.
Speaking of which, you mentioned companies bringing back their employees to the office and everything. Do you think AI has impacted business growth right now, or their business strategy?
It's hard. Well, first of all, AI has definitely impacted just general economic growth, because there's a lot of money being poured into it. There's been a lot of money made, just in the public markets on investing in AI, but the money spent on data centers and the infrastructure, batteries, and so on and so forth. I don't think we have seen any major negative impact on office demand from AI yet. Will it happen? I mean, it seems logical that office space that's taken up by call centers and reservation processing and things like that you would think AI could handle would have an impact. But, I don't know that the technology is there at scale yet. I think AI so far, where it sits today, has been more effective at just making employees more productive, better at writing and getting to data research quicker and things of that nature. I don't think it's not replacing jobs yet, in my mind. If anything, it's, companies are hiring additional people who know how to harvest AI information.
What's working well for you right now, and what's been frustrating, David?
That's a fair question. I mean, look, we've been very fortunate and have been very active last year, going back to, say, really June is when, after, I don't think we didn't buy a single asset in all of 23, first half of 24, and we're on track to, I think, at the closing, we have in a couple of weeks, we'll have made about $275 million worth of acquisition since June of 24. So for us, that involves 5 different purchases. So that's an active stretch for us. So I think the deal flow, the pipeline, all of that is working well. In terms of what's been frustrating, it always takes longer than you think it should take, and people hold on for longer. So I think the frustration is there's still a disconnect. And the other segment that's been a little frustrating, we're very knowledgeable in the retail space. We love buying shopping centers. We've invested in shopping centers for a long time. And that's probably the only asset class out there that I would say pricing today is higher, cap rates lower than they were the day the Fed started raising rates. I think that a lot of new capital has moved in, and even more is trying to move into retail. I think everyone believes correctly that retail is performing incredibly well, but it's also a nuanced asset class. So I think you're seeing deals that are pricing probably more aggressive than they should, and maybe being bought by people who don't understand what happens over the life of a shopping center. So it's been a little bit frustrating that the retail's been so tough to invest in, but overall we're pleased with the market. And I think, I think the next couple of years are going to represent, the best buying opportunity we've had since the financial crisis, and, maybe a couple of months right after COVID.
Nice. And which metrics are you most focused on improving right now?
In terms of what? I'm not sure I understand the question.
In terms of your KPIs and everything, you said that right now you're on a buying spree or on a buying stretch. Other than that, what other metrics are you mostly focused on?
In our business, every property is effectively a company. So we're looking to always find ways to think differently about our assets, look at them with a new light, and find ways to drive value. Sometimes that's physical upgrades that enable you to attract better tenancy or higher paying tenants. And then in the retail space, you always have to look at your tenant roster, because retailers come and go. I mean, even in today's healthy retail market, you have names that are struggling, Party City and Big Lots and others file bankruptcy, which creates opportunities for other tenants and opportunities to buy centers that have those tenancies and potentially bring in better tenants. But, it's all about, driving income, and you're creating an attractive rent roll. At the same time, you're being mindful of expenses and try to be as efficient as possible.
Yes, of course, David. We asked you when I asked you what does your typical day looks like, you mentioned that it's a lot of client relations, right? What tactics have you been using to getting people through the door? What has worked and what do you think hasn't worked that well so far?
So, that's an interesting question. So first of all, when you're talking about clients for us, I mean, our clients, who's our client? Our clients are our tenants and our partners, right? So our tenants are a function of, who are the tenants in our properties, and making sure we're a good landlord, responsive, and maintaining tenant relations, and delivering the product that they bargained for when they sign a lease. And our capital partners are, delivering results and reporting. So one of the things some groups go out and they use social media, and they raise unbelievable amounts of money with thousands and thousands of investors. That's not us. We've never crowdfunded. Not that there's anything wrong with it, it's just not the approach we've taken. Most of our investor relationships are long-term friends, peers in the business, associates, partners that develop over time and introduce us to new partners via word of mouth. And so for us, it's more, we don't spend as much time on investor, so in that case, client development and sourcing as others might. I'm not saying that's good or bad. That's just not how we've run our business, and it's worked for us. And then on that side, obviously delivering great results is one way you do it, which we've been fortunate to do. And the other way is transparency, communication, reporting. And so we actually had an investor tell us on Friday, we were just having a catch-up call. We're a smaller shop, relatively speaking, commending us on the fact that they said our reporting was as good or better than some of these billion-dollar funds they've themselves invested in. But that's our focus, making sure that we're transparent, we're regularly, consistently, and thoroughly. And if you do that and deliver good results, your customers will want to stay with you.
Any competition? How are you keeping yourself competitive right now, David?
There's always competition. Every day is a knife fight. We're competing to buy assets, right? We're trying to get selected as a buyer. Sometimes it's because we believe enough in the asset to offer the highest price, and sometimes we may not be the highest price, but we hope that our reputation and whatnot, make a seller think that we're the highest probability of a closing and best choice. So it's not just about price. Who's going to execute? Who's going to perform? We're always competing for deals. We're competing for tenants. So that's just part of it. That's what makes it fun.
And any bottlenecks that you're seeing that when unlocked will take you to that next level in the business?
Look, it's all about, at this point, it's about finding the right opportunities. We are not, and not, this is not a criticism of others' business models, because Blackstone has a great business model and they make lots of money for their investors. But there are some funds and others that their business is driven by fees. Get to a certain size and you make enough fees over, through the assets and the capital that you're responsible for, and that provides you what you're looking for. For us, we're more of I guess boutique is a word, but at our size, our focus is on the profits from the deals. Paying fees, keep the lights on, whatever else. But we're not at the scale where that's our focus is buying great assets. And I think we know our market very well. I mean, I've been operating in the Southeast for 30 years now, 30 years. And, the biggest bottleneck is deal flow. And I think we're going to see an uptick. I mean, we've seen it every year since 2023. And when I say we, I don't just mean me, I mean the market. And I think it's hard to call a top or a bottom, but you heard Jonathan Gray indicate he thought the markets were bottoming. And I think that's probably true. I think that the banks and the borrowers delayed for a while. Partially because there was no transparency as to values. Now that there's been more transaction activity, bankers can get a better sense of the position of their collateral. Borrowers may not like their position, but at the end of the day, I think it's time for banks to take that old loan that was given at a low rate that's now potentially 95% loan to value and push it out the door so they could do a new loan at today's rates with a new customer at the right leverage. So I think you're going to see a lot of that occurring over the next couple of years. And, we're pretty excited to be and think we're very well positioned to capitalize.
Nice. Any big plans for 2025? Where do you want to be in the next 6 or 12 months from now?
It's more of the same. We're going to close out the fund in the next, in terms of capital raising in the next 30 days. I think we will exceed our initial target. Exactly what percentage by, but we definitely will. I think I view our acquisition in our portfolio as already being ahead of projections, and I love the quality and makeup of it. And I think that this will be a very active year on acquisition. So, we're excited for that. So it's really just, we've spent the last couple of years getting ourselves in this position to have a fund, to have the capital relationship, to source the deals. And I think, it's going to really start bearing. It already has started bearing fruit in a meaningful way. And I think the pace is going to increase.
If you could solve one major challenge today, what would it be?
Well, probably in world hunger and global warming and all of those things, poverty and, things of that nature, war. So those are obviously bigger issues. I don't really I don't look at it that way. I feel, every acquisition opportunity, every property we own is a bit of a puzzle. There's different ideas, there's different ways to solve it, there's different ways to improve it. And you come in each day, and what I love about this business is it's like it starts fresh every day. There's a different thing to think about and come up with a better solution. Something that has an office component the other day. Someone said, "Hey, what about medical?" So we said, "Oh, it's turn to medical," or "What about this?" Or turn. There's always different ways to think about things and build a different mousetrap. There's no big. I don't view us. We're fortunate, right? A lot of people, the business, and a lot of the deals that we're seeing are because people bought a lot when rates were cheap and they paid a lot for it. So we're fortunate that we're not coming to work today and being like, "Oh, I got to fight this fight and solve this problem. And how do I get an extension and not lose this property?" We do not have any of that right now. So, knock on wood, we're lucky, we're good, we're smart, we're conservative, whatever the reason is, we happen to be in that situation. So every day we have to come in the office and play offense think about how to find and solve for the next opportunity.
Well, that was great, David. Thank you for sharing these insights. Where can people reach out to you if they want to get in contact with you?
Best thing, you can send an email to info@Highline, HIGHLINERE, as in the word real estate, and the word capital.com. So info@HighlineREcapital.com.
All right, great. Thank you again for your time, David.
Yep.
Have a
Thank
good
you.
one.
All right. Thank you very much. Appreciate it. Thanks,
Have a
man.
good one, David.
All right. Take care. Bye.